Happy Friday, everybody. Welcome to another episode of Real Assets Weekly. With me is my man, Jimmy Wang. Jimmy, how are you?
Happy Friday, Turtle. Good to see you. End of the quarter. Today's Mid-Autumn Festival for all my fellow Asians that are celebrating eating mooncake, watching the moon. I'm watching the market still. Things are a little tricky now, right? Since we last spoke, we've had a couple weeks where the market's pulled back, seen some volatility. Um, we're still alive. We're still kicking. Let's talk.
I love it. I love it. And it's great to see you. And speaking of mooning, I mean, no place to start better than if you're feeling gravity a little heavier this week, it could be the 10-year yield and its effect on potentially your portfolio or your life. And the first thing I wanted to solicit Jimmy's feedback on here is, where are we at on this? It's funny. So this is Real Assets Weekly number 15. And let's see, it was about a month ago. Excuse me, about 6 weeks ago was the last time we chatted. It's been too long. Let's not let that happen again.
Yeah, no,
And,
for sure.
and on Real Assets Weekly number 12, we talked about the ghost ship scenario. And the ghost ship scenario was in the movie Ghost Ship. It stems from the idea that when the curve flattens out, everybody dies. And in the movie Ghost Ship, the opening scene, there's like this wire that snaps and it like rips everybody's heads off that's on the deck of the ship. And so the idea is the yield curve flattening is that could there's like this nasty case of bear steepening going on, and it's putting pressure on people that are dependent on short-term funding for their business, putting pressure on a lot of people.
Mm-hmm.
What do you think about it? So it's interesting that the ghost ship scenario is maybe playing out to some extent. Equities, are they having like a Wile E. Coyote moment where they haven't just realized they're off so what do you think about all this? Fast move, huh?
A very fast move. I think the last time we spoke, the 10-year was trying to hold the line, right? At like 4.3-ish,
Right,
4.3, 4.4. We
right.
saw that last bit of resistance before with this last move up. And bear steepening is right. Most people only know about the bullish flattening or the bullish steepening, where, hey, the 10 years moving up because, who knows? But here's the skinny, right? It's everything's connected. You see demand for interest. I mean, anything that's interest rate sensitive has lost a bid. And if it's not the hedge funds buying the 10-year, who else is buying treasuries at this point? The 2-year, the 3 month, you're still getting 5.5, right? So the retail interest is hard to find here unless you're trying to lever up that 10-year.
Right,
you
right.
know, to good or disastrous effect, I suppose. But it's at least I'm seeing kind of a similar set across a couple different things. And what's strange too is that some people say, hey, this is still stagflationary, where we still have inflation. There's a little disinflation, but even in the last month, we've seen some commodity weaknesses. We haven't seen oil participate in the same kind of way, gold, agriculture. There's been this kind of broader, it's hard to say it's risk off, right? The price action would tell you it's risk off, but we've had this vicious climb in risk assets, especially in tech and interest rate sensitive things after we got slaughtered in 22. And we're starting to make that lower high, right? It's the lower high from even 2021. And this chart, thanks for pulling that up. You see that
Yeah,
perfectly.
yeah. I'll go back to it.
Yeah.
Yeah, zoom in a little bit. Yeah. No,
Like
yeah.
unless you find support right here, right in that little mini dip, I mean, um, what would the technical chartist say?
Yeah. Well, quite frankly, who cares?
Yeah,
But
quite frankly,
no,
who
I'm just
cares?
kidding. No. But it's because that's a little joke pot shot because it's like, on FinTwit at least, it seems like the technicians are, extremely bullish up here. They're getting bearish down here, and it's like, okay, thanks for coming out.
But what I will say is, for
Yeah,
some of these names that were bullish trade and trend that recently lost some of their trade strength, I mean, you can say, hey, it's still a bullish trend over this year. Maybe it's still bullish, over a longer duration. But, we're at a very, very, fragile moment where you got to keep these names in a tight leash. If you've been riding Nvidia, if you've been riding Apple, riding some of these tech stocks, right? The either QQQ or just the S&P 7. Um, it's a time to get a little bit more alert about what the downside could look like versus the upside, right? What's the upside? We're going to go back up 5%, hit all-time highs, and what does the market have to do?
right.
And where are we with the VIX, right? All these different movements together. Maybe there was a seasonal strength over the summer, but it's starting to erode pretty quickly.
Right. I think that makes a lot of sense. And I think that the the question, I guess, that everyone's asking is is 4.5% on the 10-year treasury, is that a survivable level of oxygen in the financial atmosphere? Like, I'm just curious, and I don't think anybody knows, but I'm curious of your opinion. Do you think, to your point, to your point, the bear case seems a lot juicier, has a lot better kind of risk reward from here than the bull case. But again, but that's, I don't know if you can take those, back of the envelope cases to the bank necessarily. But I guess my question for you is, really it's looking at 2018, right? When we had the last time the 10-year treasury really kind of took off, that was the taper tantrum, and that led to a pullback. We had this spike in yields this is back in October, and that led to a pullback, but this one's not. Or I guess, so my question is, 4.5% on the 10-year. Do you have thoughts on kind of specific implications for real estate stocks or stocks broadly?
I'll speak to real estate.
Yeah.
I don't know that the 4.5 is a magic number, because when you look at the longer term laddered maturities that a lot of the REITs have and that a lot of private equity portfolios have, if they're investing over a 7-year timeline or a 10-year timeline, let's zoom out a little bit further. Prior to 2018, obviously rates were higher and they came down, right? I mean, we've been hovering in this area, but
Yeah.
I'll say this, property level debt financing has been frozen for the better half of 2-3 years now, unless you're in an asset, right? As interest rates have climbed. And correct me, I'm wrong. Even for most of the mid last decade, the 10-year was very suppressed. I think someone said, hey, we're getting back to 2007 levels, right? We haven't, the 10-year hasn't hit this since prior to the GFC. And so again, property level debt has a lot of asset specific underwriting, and we all know about the issues in real estate. When I think about unsecured debt, the EQRs, the Avalon Bays, these larger companies that have access to, really good, capital financing. I mean, what's their spread over the 10-year?
Right.
If it's not 100 basis points, we talked about it. When interest rates are at the rock bottom, sometimes you see the spreads blow out because just the all-in rate would be too silly. And then sometimes on the high end, you actually see some spreads compress as the 10-year blows out in a rapid period of time because the market's not fully adjusting to it yet. But it's a dangerous scenario. I don't know where the floor is. I think you want to talk about triple nets a little bit. Perfect example, right?
Yeah.
Has the business model changed? No, I haven't gone to Chick-fil-A any less. Right. I'm still doing my thing. But you're looking now, we're kind of there, COVID level lows, and that just, again, directly inversely correlated to the 10-year. And that was, as easy of a call as I could have made, despite some other property sectors taking it on the chin even worse. I mean, this is just a pure interest rate, interest rate inversion or play or what have
Right.
you, right?
No, that's exactly right. So yeah, I think this is an interesting triple net to look at. Couple quick points here. I think let's go to the deck for fun.
Yeah.
Of course, feel free to go to the www.swamiresearch.com and you can sign up to get the daily email. This is an example of the daily email. This is today's. And let's go to the section on real estate investment trusts. We've got a couple pages on REITs. And here's office. And we're looking at more, let's say,
a lot
like
of red arrows.
A lot of red arrows. Housing, where is my realty income would be? And what do we call it? Okay, yeah, we're calling it a excuse me here. Dang, where's my realty income?
Maybe in our individual stocks.
Oh, here it is, consumer. Excuse me, consumer. All right. So, but what was interesting about this is this. Number one, it's well, not surprising, right? So, in general, these triple nets, a lot of these are triple nets. IIPR is a triple net, NNN triple net, O's and triple net, WP carries triple net, and I believe Vici as well. Yep. And so those are the most highly correlated to TLT, which is not what you want to be correlated to right now. And to Jimmy's point, so really the point is that different stocks are down for different reasons. But if you can find the ones that are just down because TLT is going down, if you think interest rates might or long bonds might catch a bid here, that might be the play. Like to me, let's pull it up a different way. Let's look at this. Realty income is back, and again, realty income is interesting. I believe they have the highest credit rating of all the REITs in the United States. If not, they're right up there. And so they're just an interesting, like almost bond proxy to look at. And if you pull up this chart, we're going back here to, this is the historical drawdown. And if you go back to 1996, when the company became public, we're now in basically the fourth biggest drawdown since inception. 08, yeah. You had yeah, 2013 you had like a little redux of some housing concerns, I guess. Then you can see 18 there. This just eclipsed 2018's drawdown, and then really the COVID lows. But last slide on this, if you look at the yield though, let's go to this is go to the dividend, and if you just look at the yield from a COVID, you're coming up on COVID lows because the dividend's gone up several times since March 2020. So you're almost getting the yield you were getting at the COVID lows, Jimmy. Are you interested?
No.
Oh, tell me more.
During the COVID lows, what was the risk-free rate?
Right. True. About went down to 0.5.
Especially, I think in the past segments we've said that, hey, these triple net names, especially realty income, has a lot of retail love. The grandparents love that monthly dividend.
That's right.
Frankly, 6% for something that today has some credit risk priced in, but we know as a business model has been very rock steady.
Right.
You're still collecting a premium to the 2-year, to the 3-month, right, to the 1 year, certainly to the 10-year. But there's not a lot of institutional interest, and that could be said for the broader REIT sector, right? There's always idiosyncratic retail interest, but when I think about financials, which have their own problems, REITs, which have their interest rate sensitivity, these are just not, they don't have defensive factor exposures today. A lot of their factor exposures are right in the crosshairs. And so that institutional, even the opportunistic hedge fund, what hedge fund is long realty income? At most, if you're in a pod shop, maybe you have a long short and you're picking over, some smaller caps, or you have some quality bias, but the incremental dollar is just not to real estate today. And that's troubling at a time where commercial real estate is due, right? We talked about all the commercial real estate debt that comes in 23. You continue to have a frozen CMBS market. We still have, I think this is probably a good segue. I was reading something in the Portland Business Journal, and Portland's never been an institutional market, but there are a few larger properties which, in various points in the cycle have commanded, 8-figure sales. We're talking $100 million plus deals. And one of the most recognizable institutionally held type of assets in the downtown area, in like a decent part of downtown, not the part that got completely hollowed out, is that traded for 40% less than its 2019 valuation. Now you slap on some property level debt there, the equity guys basically got wiped out. They took an 80% haircut.
Wow.
Would you say that's a distressed sale? I don't know. The brokers would tell you, hey, we're so relieved, we just got a mark, any mark. And I think increasingly, whether you're in a major city where this game of cat and mouse or playing that chicken game is going to persist for longer, as someone say, this is going to be a lost decade, a lost half decade, just because of, you have to realize what that value is. And if you bought in, unfortunately, now, with the market peaked in the middle of the last decade, and it's not a foregone conclusion. Maybe it is a foregone conclusion, but it's like you can say with some degree of confidence that every single property transaction that's taken place in the last 5+ years, even, certainly within the last 5 years, but in the last 5+ years, they're in the red.
Yeah.
They're in the red with financing. They're in the red with fundamentals. Maybe the rentals, if you had short-term rentals, manufactured housing, self-storage, like the property level NOI has increased, but certainly from a cap rate perspective, from a financing perspective, from a opportunity cost perspective, people that park their money into these large illiquid assets have gotten burned, and that is still in the process of being realized.
Right. And like we talk about every time we've sat down and recorded one of these, I think the attraction with one of these names that trades is at least we're getting mark to market every day, or we're getting maybe not on the NAV levels, but on with the actual share price, buyers and sellers. Yeah. And because basically another version of what you're saying, back to the 5-year look back thing, is like the private mark of your private portfolio probably doesn't look too different than this stock chart, right? I mean, if it was marked to market all the time.
Trended, especially over the last 7-8 years, from
right.
point A to B, that looks about right.
Right. So the question is kind of, when does the markdowns really start for the private assets? And that's something that seems like, we've seen some of it, but it's something that's been speculated on a lot. And to your point, maybe it's a really good transition to office, because some of these office names look a lot better.
Hey, Turtle, right before we leave, I wanted to point out
please.
something on that chart that I thought was quite interesting.
WPC.
Yeah. Oh, for WPC and for Realty Income. But
okay, yeah.
Look how quickly over this last month, there was maybe a little bit of support at around $55, right? Yeah. You saw that first drop and then retesting that drop maybe just in July, that July period. And you see that line held throughout COVID, that $55 line, 55 to 57.
Right.
And again, with these names, we knew there was a declining bid for the asset, but as Keith says, a lot of other good, like, just market technicians will say, like, as soon as you lose that whatever trade support, I mean, you're right back to some of the older lines, and it's things crash from oversold levels. And if I'm a gambling man, I'm saying, hey, maybe there's a reversion play here. We know that TLT has been really oversold. We know some of these things, but going long bearish trends is a way to lose your capital. Right? Trying to catch that knife. And so we're kind of back in the knife catching moment for some of these interest rate sensitivity things, because you could easily see a week, right? After quarter end, we could easily see something where these names are up 3 to 5%.
Yeah. Well, so
What's the
So
period there?
yeah, no. So on that, that's a great point. So no, that's something I've been thinking about. It's like, to your point, I mean, I think the last 3 years we've really been a great examples of, like, any trend that any trend, a 4 standard deviation move is a precursor to a 7 standard deviation move. You know what I mean?
Yeah.
Like, it's like any trend that you think like, oh, right here is where it's going to end. Like, it can go further. Trust me. Whether that's, cryptocurrencies or yields or the dollar, like we've just seen.
Facts.
Yeah,
They
right,
can't
right.
go all
Oh,
cash now, right?
right.
Yeah.
Oh, it's got $3 of cash on the books. It's a screaming deal at $2. No, no,
One.
no. It's now at 15 cents, and it's still not a screaming deal. Um, and so the point is, like, this chart, going back to the technician thing, it's like, this looks like, I mean, I'm not a technician, but from the technicians I've talked to and a little bit of technician stuff I've read, it's like, this looks like a SPAC, like you said. Now it's like a SPAC that broke 10 or something, and it's like, uh-oh, look out below. We have no idea where we're in price discovery mode now, right? Like, we're just trying to figure out where this thing's going to land. However, now, and you do a great job of calling, kind of helping me hold my horses here. But however, this isn't a SPAC, right? This is a real estate portfolio.
Multi-billion-dollar one at that.
Yeah, that's
with solid business models.
right. And you could work backwards and get a cap rate on every transaction they've done and what those current cap rates are. And so that's a big difference, I guess. Like, I'm much more interested in buying. What I'm trying to say is, I'm much more interested in buying bearish trends that seem oversold in stuff that for sure has intrinsic value than I am in stuff that doesn't. I don't know. Kind of just an obvious statement, I guess. Now that I take the
Well, to
time.
hit 42, get that limit buy-in.
Yeah, right. And so for you, you look at this chart, is there anywhere that you'd be taking a poke?
I think we don't have this pulled up, but one of the things I always refer back to is that in the REIT space, I want to look at yield spreads. I want to look at, here you can even look at a dividend yield spread to 10-year and see how that's trending. And again, that gives you if you even look at historical bands of where interest rate sensitive names like Realty Income have traded at the height and at the trough relative to that 10-year, that perceived real estate risk-free rate, again, at $42, if the yield is 6% today, at 42, it's probably like 8%, and then if the 10-year is hovering at 5 and you have a 300 basis point spread, then you can start comparing versus historical periods. And Realty Income's been around for decades and decades. So when we're looking at margin of safety from these more technical comparisons or these historic relationships, all I say is there's still a ways to go.
Yeah, that's a very good point for you young REIT nerds at home. That's
just my margin of safety. Obviously, you can have that 5% bounce back next week, right? Like, we don't know. But as far as, the fundamental margin of safety was 20% ago, because all the things we're saying now were happening when the stock was at $70, and saying, hey, why isn't this back to its pre-COVID high? Look at all these other property sectors that rebounded, 2x since 2019.
Right. Yeah, no, I think that's a great way of looking for that margin of safety. I really appreciate that point there. Let's move on let's talk about some office stuff. And maybe one way of framing that is like stuff that's this looks oversold here. We got at Swami Research, we got a fractal reversal alert in PFIX yesterday. So that's the simplify interest rate hedge. So, like, from a fractal standpoint, which means on a bunch of different time period lookbacks, Realty Income, yields are overbought, Realty Income's oversold, PFIX is overbought, TLT is oversold, right? Like, that's sense. Yeah. So that's an idea. Yeah, personally, I'm buying some O. Would I follow me? No, hell no, because I've been buying it for a while, so I wouldn't be following me. Follow Jimmy. that's on that. The other one, so, but on office, maybe it's the opposite. We've actually had a nice bounce here off the low. I mean, these guys have almost doubled from 12. Let's see, what was the other? OFC looks the best on our sheet. OCF. What's the office? OFC.
Yeah. Let's see.
Yeah, I don't know why it's not pulling up. But what else we got? The other one is VNO, SLG. SLG is the other office name. Got a nice bounce from 20 up to 40. So this is almost doubled. ESRT. So yeah, just curious if you have, I saw you had some thoughts on SLG, it looked like the other day. Do you think this is back into Jimmy's short sweet spot?
I think, I was, to be honest, I was following Keith's, signal, and you can see that at around 41, 42, right on the button, we're hitting that.
Nice.
The technicians will say, oh, look, it's a reverse head and shoulders. It's going to moon now, right?
Yeah.
Like you're looking at that little trend, certainly, going into the second quarter, and you look at the 2023 year-to-date performance, there's a period of time right around that March period where they released full year guidance. They're at Citigroup, in Florida, and just the year, there's not a lot of good to be said about that. So in some ways, maybe there was some capitulatory selling down there. But when I look at just the volume profile and where it's trended back, we're back to kind of year-end valuations. But for a name like SL Green, 45 is a big number. And, we're not technicians here, but there's not a lot of fundamental catalysts that is going to take the sector higher. In some ways, when you think about the delayed impact of rates flowing through to different interest rate sensitive, sectors, office probably took it on the chin first, and then we're seeing other sectors follow. So again, I don't have all the insight into this anymore, but if you were to follow the flow of capital out of the sector, you can see kind of a coordinated wave of selling where the thematic, the narrative ones that had no business, with your capital were gone first. And as interest rates have climbed higher and, just over the last month or two, we're kind of in that Jerome Powell, hey, we're higher for longer. We're going to sustain it, right? Maybe we raise, maybe we don't, but we're going to try to keep it. And so that sustained yield pressure on these sectors is starting to come to roost. And now the interest rate, the generals in the REIT sector have gotten shot.
Yeah. No, I think that that makes a lot of sense. And I think that, the question is from here is like, at what point does it's so we're waiting. Are we in the kind of Wile E. Coyote moment here where interest rates are so high that is it to the point where we have to worry about these businesses as going concerns? Probably some of them, and others not as much. Is that right?
I think for these larger companies, I don't see them as having going concern issues. What I do see them as potentially having to deal with in the next 12 to 36 months is a period where interest rates are not accommodative. The fundamental outlook is not bullish, and you have a continual erosion of cash flow because these REITs generate levered cash flow. And so the financing costs are higher. The internal growth is either muted, certainly not accelerating, and the properties are getting older. You need more in CapEx. I don't think you're going to see some real dilutive equity raises, but I think the moment that we get price discovery in a more meaningful way, companies, I think, if they haven't gotten some religion and have come to the sense that this is no longer a pre-COVID environment, this is no longer even a 2021 environment, companies are going to start honestly looking at their capital and say, hey, we thought we had 5 cap rate assets, but the market says it's 6.5. If the market has a point where REITs have a momentary bounce and some of these REITs, on the implied cap rate basis get to 6.5 or 6, there is going to be some pressure to raise equity. because the leverage profiles have creeped up, right, as the market caps have eroded. And that's going to be difficult. No one likes getting diluted at the bottom. We saw that happen with a lot of these companies, and this one, oh my God.
Oh my God. Yeah, exactly.
DEA, you
Yeah.
know? I know we don't like the DEA, but
yeah. Yeah. Don't these guys like rent offices to the government? Like, isn't that like the safest business in
this
the
is a
world?
classic story. And again, you have to zoom out further. This is over the last 3 years. I want to show like a 10-year chart of this bad boy. When they IPO'd,
Stanky.
and what a story they sold. So right at the height of the bubble, I mean, not the bubble, but you look at that 2015 period for office. I mean, that represented the height of the office market. This is a company that has real estate assets in the middle of nowhere, but because they're leased to the government with long-term leases, they managed to, position themselves as a very high credit rated bond plus proxy, rather than a very low quality rural slash suburban 2-story office building company. And you see there are different periods where you'll hear a rumor that someone's trying to get out of Nebraska and there's no residual value for the building, and then the government signs a 20-year lease and everyone's like, oh yeah, this property it's good, the cash flow is good, and we're kind of back at the point where, yeah, bro, you've got 20-year leases that are now 10-year leases, and you're in the middle of nowhere, and you have a suburban office portfolio. So, that's what this company is.
Yeah, no, and to your point about it's funny how things go, man. This is this thing
After exposure. Look at 2020. Oh my God.
Yeah, right. No, I mean, imagine having a cost basis in the 20s, and then now you're at 11 and a half, and you're just kind of holding the bag, maybe trying to average down. I mean, it's a tough situation, especially with these yield hog type names, because there's such a tendency to double down because it's safe and it provides an income stream. And that, of course, can get very
dangerous. You put on a suit and tie and you go to Manhattan and you see SL Green properties everywhere. Right. SL Green is probably yielding like 15% now, 10-15%.
Yeah. Right. Passive income, baby.
Generational wealth.
No, and I mean, Vornado, let's talk about this before we move on. And I didn't prep you for this, so maybe we'll do this. Would be a fun one to dig into maybe a little bit sometime. But get back on the trail there, this guy a little bit, because and also this is a transition here, is that you recently, I believe, shorted some more Bitcoin. Didn't these guys put a bunch of Bitcoin on the books? And so I wonder.
SL Green.
Is that SLG?
Yeah, SL Green, I believe at their 2020 or 2021 investor conference day, they put some Bitcoin in there, kind of at the top of the market.
Yeah, of course.
Classic.
They're no better than us, right? Like, it's like that's the thing about tops of markets, is that's when things sound good. I mean, that's the problem.
Of course.
So I don't know if that's even a better reason to short them. We'll have to, of course, we'll have to dig into it, but
there's not sufficient capital there. Their story was a little bit more idiosyncratic, where they had a sizable crypto tenant join one of their buildings. And so I don't know if this was just kind of a creative financing arrangement, or type of a, tenant equity participation thing.
It's like a pick, another form of like a pick. They're just
because I mean, you see that it's actually quite prominent in the real estate space. You think about a company like Alexandria Properties. They have a lot of biomedical tenants, a lot of venture capital startups, and in addition to having, for these companies that could blow up, right, they often take part of their payment in stock, so that they do have some equity participation if these companies become the next Pfizer.
Yeah. No, I think that makes a lot of sense. Okay, so I want to get you out of here before you got to go, and I've got some tennis balls to hit you before we go. Let's jump on the Bitcoin tennis ball if you're good with that.
Mm-hmm. Yeah.
What do you are you surprised at how resilient it's been? It's kind of, it looks like you shorted higher. Just
Yeah, I kind of reloaded up
yeah.
meaningfully at 31, 32, which is right at that resistance line, and
Okay.
again, I wore a lot of that throughout the year. I've had my short
Yeah.
for some period of time, but that was the last on the down. In 2021 found some support there, but since it lost it in the middle or in last year, we had that freak out moment where we got down to 16. At that 31, 32, I start building it. And here we're kind of, a technician would say there's definitely some support here. There's some
Yeah.
different aspects, right? Where over the long term, there's some volume accumulation right at this line. I still am hodling that position. It's not levered. I don't have a huge size in it, but I still think of this as a levered QQQ play. But there are definitely some quad 3 factor exposures, right? Where people think about the money printing and just as a, as another proxy for any potential type of inflationary print. I think some of the CPI reports, when CPI has been high and the market sold off earlier in the year, I think Bitcoin caught the brunt of some of that. But then I think in more recent months, I think what you've identified, we have this bit of a band here. But I think, if the Nasdaq goes down 15% from here to year end or to the actual trough of whenever that is, I don't think Bitcoin's higher. So it's still a risk asset, in my opinion, from a volatility point, from a portfolio management point.
Yeah. Yeah. No, well, you didn't get the memo now. The 10-year treasury is a risk asset. Bitcoin is now the global collateral. I don't know. That's what it's trading like.
Yeah.
So no, okay, a couple closing questions for you. I think that makes a lot of sense, and I think I'm with you. Oh, how are you doing that? Are you doing that through BT, through puts, if you don't mind me asking? Because
Yeah.
there's a
In
lot of
my
different ways
my
of
Roth,
handling it.
in my Roth, I'm just using BITI,
Yeah,
which is, it's imperfect, but
yeah,
it's again not levered. I'm not going to get blown up.
yeah.
It
I'm using some of
more
that
or
too.
less
Yeah,
correlates. Yeah.
yeah, yeah. Um,
And maybe shit talking some crypto influencers on Twitter. So
yeah, hell yeah. That's
that's how I
really
express my negative sentiment, and I'll end that segment on this, like the NFT space was definitely kind of the pretty girl at the bar for a while, and it was the topic du jour. But people loaded so much of their money in dollars, getting Ethereum, buying these pictures, and I just I get a sense because I'm a little closer to the space of the people I follow, but there's so much trapped liquidity in that space now because there is
really.
no mark. Yeah, the last
Okay.
mark is not the next mark. That's what I said. Like, there's a lot of these things where the prices have gone down in ETH terms, but you really can't sell. There isn't a buyer in size. And someone else posted, yeah, 95% of the market is worth zero. I think it's higher than that. But
Yeah,
maybe in real terms, that pain is spread out among more smaller accounts than a few larger accounts. But anytime you have trapped bulls in risk assets, you know what happens. So it's that system needs to get cleared out a little bit, and
yeah,
and that's another reason why I am not very optimistic on the underlying. Now Ethereum probably has a little bit more volatility because it's kind of used for a lot of NFT projects, but Bitcoin, it's all part of the same ecosystem. There are still things where there are trapped buyers, there's trapped custodians, everyone. There's just issues across the board there, and it's taking a back seat from a headline standpoint. Everyone's like, oh, they're adopting the futures, the institutional adoption is here, but like, where's the 2x? Like, some
yeah.
of these things are well known, and so I don't think that's an additional upside catalyst from here.
Yeah, I think the trapped equity line is very good. I don't want to come back to that. I'll give you the you hit on a bunch of interesting points, but one, the Ethereum Bitcoin thing triggered a thought. We were going to talk about media stuff we saw, we liked. We didn't even really, confirm that, but we talked about it. And one that I would assign to you as homework, and I'll text it to you, and it's not homework because you don't work for me, bro. But my first million, the Blockworks guy, one of the two guys that basically bootstrapped Blockworks was on there, and really good podcast. I think that was really interesting. And he basically went to the wrong seminar. It was a Ethereum seminar. He's supposed to go to some networking thing, and he started an Ethereum. He's like, an hour later, he's like, I'm starting an Ethereum consulting business or whatever. But I thought there's something there. And I think that there's some really good points on kind of the future of finance media that I think are really interesting. So we'll come back to that, but let's hit on this trapped equity, because I thought it was a great point. And maybe a good place to close within real estate. So I'm a question and then a prompt. Question is, do you think within real estate, where is the most juice left to squeeze out? If you were looking to get short, that's I guess the question. Maybe, and here's a contention, I don't know, but maybe, is it weed? Or is it like something maybe like IIPR that has come down a lot? We're down 70% from the highs, but it's still got a lot of cap. Remember, a lot of money went in there because these MSOs can't get capital from Wall Street, really, in the same way that these guys can. So where is the most meat still on the bone within REITs? And is it cannabis? If you have thoughts there.
So full disclosure, we've seen some progress on safe banking. The MSOs have really gotten pummeled. We've seen some higher profile MSO and cannabis ETFs shut down. With some of the progress and developments in the legislative space, we've seen stocks double over the last month.
Right.
They've really come off of all-time lows almost. And I've actually doubled down. I've added to Verano. I've added to AYR. I still have my tier 1 green thumbs. And so it's interesting to see that IIPR, as the landlord, has it's taken it on the chin with the interest rate exposure, and it hasn't gotten any of the cannabis love. So I'm not surprised by that. What I will say, as far as meat left on the bone, is I saw some of these movements briefly in 2010. I saw them in 2016 around Brexit. We saw them during COVID, and all REITs, I would think at this point in the juncture, being oversold the way they are because of the 10-year, because of these other things, their correlations are so high that the individual stock picking right now, I think at this juncture, is less of a focus for me than where the sector goes, because we could still crash. If the 10-year works up to 5%, every single REIT is going lower. I'll bet my life on that. So when I think about the sector beta and these individual names, frankly, there are not many places to hide. And part of our earlier discussion was seeing the cascade of capital flow from one sector out of another sector, out of another sector. And by all metrics now, they're just oversold on a couple different conditions.
Right.
I don't know that you can go to the drawing board and say, again, when you look at the line, it's fitting that we're at quarter end and you see we're right at support, but maybe support was a little higher. And just this last week, we're trying to fight back, and we don't have a lot of, I guess maybe that supports resistance now, right? Again, from a technician, and seeing the way that the 10-year just completely, crashed through 4.4 and higher. I guess crashed to the up, right?
Collapsed. I know what you mean.
Price collapse, bonds exploded. Right. That's my North Star right now. The 10-year is my North Star when it comes to thinking about real estate allocations. The 2-year, right? The money market funds now, if you're in SGov, 0 to 3 month treasuries, that's 5.5%. these, these various money market funds I've implemented for some clients, the 7-day yield is 5.3%.
Yeah,
And there's just, you imagine that's attractive to an institutional too.
for
You don't have to
sure.
pay costs. You don't have to
Right,
identify asset. You don't have to do the underwriting. You're just getting paid while you wait. And
right.
if the Fed says, hey, we're going to keep this for 12 months, that yield is pretty good,
Yeah,
right? I might just lock out the year, take my 1 to 2% for this last quarter, and if I'm an institution, right, and then start publishing some white papers without having to take a market position on it.
yeah. No, I love I love it. Okay, I think that's a great place to end it. I think that you gave us a lot to kind of a lot of ideas to really look at. To your point, I really think cannabis is such an interesting long-term story. And then it got even more interesting short-term because all this capital came in right at the top.
Yeah.
That was when all the excitement was, and right, stimmy checks are going out, and there's all this optimism about legalization that just kind of didn't go anywhere. So I think that there will be it's definitely an interesting one to watch play out. And that's what's so cool about real estate, about REITs in general. I saw a post the other day, and it's like there's a lot of almost interest in by millennials in fractionalizing and digitizing real estate. And it's like, guys, RIP Sam Zell, like they've been doing this. It's called a REIT. They've been doing this for a long time. And our man
I'll let
Jimmy
you
knows him
finish on
real
that,
well.
but even Sam, I remember something he
Yeah.
said, but this echoes with most people. Like, people love to buy things they can touch.
Yeah.
Stocks can be very intangible, and when they think about buying a building, it's like every kid's played Monopoly when he or she was little, and there's an allure about being owner of a building, being owner of a piece of real estate. But money speaks. So it's not a very efficient or liquid way to get real estate exposure. But that doesn't mean there isn't a demand for it. I think
Right.
there's definitely retail demand to say, hey, I own part of the Empire State Building.
Yeah.
You could buy an SRT if
Right.
you want. Yeah.
Yeah. Great, Jimmy. Great to speak with you today. Thank you for your time. We'll do it again soon. Don't worry. We won't make you wait 6 weeks to see Jimmy again here on Swami Real Assets Weekly. And download the daily ETF report at www.swamiresearch.com. Jimmy, thanks for your time. Have a great week, everybody.
Errol, thank you. Everyone, thanks for tuning in. I think we got another busy earnings season coming up in just a couple of weeks now. Nike reported yesterday, again, kind of a non sequitur, slightly better than feared. I think the broad commentary, and we didn't get to touch on XRT or retail, but some of these names have just taken it on the chin this quarter. Yeah. Nike is back to almost not COVID lows, but for a company that's 140 billion of market cap, it's down 50% in the last year, right? Yeah, in the last year since the highs. And the commentary between them and a lot of these retailers is, hey, we're going to enter into another promotional environment this fall as the consumer softens and we have student loan payments and all these other factors coming in to roost. The company has done a good job of reducing inventory, so they're not marking down their assets. There's a better product mix that's driving margins. But as a global proxy for where the consumer is, this chart kind of shows you, and XRT, it kind of shows you at least where the market is taking bets on. So we'll watch to see what the next couple months hold for the broader economy, but I think this is very telling of again, don't get too bullish, don't get too bulled up, chasing some negative trends, and we'll find out.
Yeah, love it. Interest rates are really throwing these markets into some
they are now
into a bit of a tizzy. And I think there's
opportunity. We're in that break ship part of the phase.
We're in the break ship part of the phase. And I think there's going to be really interesting setups, long and short. And really excited to continue to learn from our man Jimmy here. So thanks so much, guys, for coming out, and talk to everybody soon.